generally I find two very clean, significant highs. So this is a fairly significant high, and this one is another significant high. What you want to see is a very strong rally that breaks through 1 and 2. If you can bust through 2 resistance levels, usually that first pause and pullback can be bought. And if it is a very strong move, it actually will turn the moving averages up fairly quickly if it breaks those levels, because prices has moved significantly higher. So the 20-day will turn up very quickly. The 5-day will be above that. The 50-day can turn up and start sloping higher.
2 days doesn't make a bull market, but it's an encouraging sign when you see these kind of moves. But even if you go back a month, you see that the GDX and the GDXJ are outperforming gold meaningfully. So that's a positive sign. But if you look at the silver chart, it's nothing in tandem about it, but they've moved about the same amount over a month. So this is a longer term trend. Yeah, so I would say that's positive.
Precious metals and mining equities are displaying encouraging technical recovery signs despite lingering long-term downtrends across weekly charts. Strong upward price moves that successfully break through key overhead resistance barriers can rapidly flip short-term moving averages upward to confirm positive momentum. Veteran technical analyst Chris Vermeulen and renowned asset manager Adrian observe that clearing double resistance levels usually allows initial consolidation pullbacks to serve as attractive buying opportunities. Mining stock ETFs such as GDX and GDXJ are meaningfully outperforming spot bullion over multi-week timeframes, signaling building institutional demand across the hard asset complex. Based on these technical patterns, gold, silver, and mining shares are predicted to drift higher alongside a broader equities rally over the coming weeks or couple of months. Nevertheless, traders must remain disciplined, as counter-trend rallies often run into major resistance and roll over unless sustained volume supports a full bull market transition. Monitoring price action near critical resistance zones will determine whether this rally evolves into a lasting trend. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
In a nutshell, the long-term trend is down. All the other moving averages are down. We've seen a drop, a bounce, a drop. This is kind of a bearish formation. Maybe we see gold. As I mentioned, the dollar may just trade sideways for a while. The stock market rallies. We might see gold and silver and miners, work themselves higher. But I still think it is a pause at that point, before it potentially starts to sell off in a bigger way. And that's what we need to be aware of. And silver's doing the same thing. I mean, a good example of this, Craig, is actually like Bitcoin. If we were to look at the Bitcoin chart and, just go to these patterns, like, for example, the hard right edge, you have a sell-off, it pauses, and then it sells off, and it has another pause. And, you look at this little pause here and you're like, oh, that looks pretty bearish. If it starts to break down, we got another leg. And this is kind of where I feel like, kind of gold and silver are kind of right here. It's been a little pause. But what can happen is that pause can continue to trade sideways, and it can drift itself right back up to a previous low. And when you step back and look at the big picture, you got a leg down, you've got a pause. You got a leg down, you've got a pause. And while this can be a rally, it's still a counter trend rally. The bear market is still in place. And eventually it'll run into resistance and then roll over. And so I think very similar for gold and silver and Bitcoin and miners is we might still see these drift higher, but it doesn't actually mean it's starting a new bull market. So if we were to look at silver, silver is kind of doing the same type of thing. It's the trends are down. It's pausing right here. And I do think we're going to see most likely silver, miners, and gold potentially move higher while the stock market rallies over the next few weeks or couple of months. But it's going to be what happens after that. Like how is this price action going to unfold? We really want to see some bullish price action. Ideally, we want to see strong rally, some type of pause and consolidation, another rally. We really want to see the moving averages start to turn up. And we don't really want to see a drift sideways because usually they fizzle out. So that's kind of what I'm keeping my eye on. Yeah. The thing with a 50-day moving average is we need 50 days of higher pricing on average for it to start to turn up. So, I mean, it's going to take a while, right? If you want to forget that and look at momentum and pure price action, what I look for is a impulse move. And an impulse move is generally I find two very clean, significant highs. So this is a fairly significant high, and this one is another significant high. And so ideally what I would want to see, you could argue this is a significant high, but I like to use very, very clean ones. What you want to see is a very strong rally that breaks through 1 and 2. If you can bust through 2 resistance levels, usually that first pause and pullback can be bought. And if it is a very strong move, it actually will turn the moving averages up fairly quickly if it breaks those levels, because prices has moved significantly higher. So the 20-day will turn up very quickly. The 5-day will be above that. The 50-day can turn up and start sloping higher. So that's that would be like the best case scenario. We see a huge strong move in precious metals. It takes a bit of a breather and a pause. And then obviously if it starts to run and break out again, then you're going to have that second measured move. And then we could be right back into a full-on bull market and the next big leg higher. So that would be the way that it turns around the quickest.
2 days doesn't make a bull market, but it's an encouraging sign when you see these kind of moves. But even if you go back a month, you see that the GDX and the GDXJ are outperforming gold meaningfully. So that's a positive sign. And you're also seeing silver and gold move about the same amount. I nearly said in tandem, but if you look at the silver chart, it's nothing in tandem about it, but they've moved about the same amount over a month. So this is a longer term trend. Yeah, so I would say that's positive. If you look at what the big negatives for the complex are right now, I mean, the big negatives are we've got a war, which means a higher dollar, which means higher yields, which means a higher oil price, which means concern about inflation and central banks raising rates. I would argue that all of that is now priced into the market. Unless we see the Federal Reserve and other major central banks raise rates more than expected, I would think there's a reasonable case for saying that it's already in the price. It's already discounted. When you come to the gold market, I don't think there's anyone out there that has inside information. Unless you're the Bank of China, you don't really have inside information on what's going to happen to the gold market in the next few days. And again, let's just put a little bit of caution on it. We are only talking, I mean, you could extend that back to, you gave today's numbers, but if you look back yesterday as well, then the outperformance is even more astonishing. If you go for the last 2 days, but it is only a couple of days. We've seen it over the last month. We're just getting this increasing mood indication that maybe the bottom's in, but maybe we're not going to test that low again. Over the last month, we've seen inflows into the GLD and GDX, not massive, but increasing, and then more recently into the GDXJ. So I think we're just getting this gradual, nothing gradual about today, but we're getting this sense that maybe the market has bottomed, that certainly that the stocks are cheap, are undervalued, and that maybe it's a good, and that the worst news is discounted.
Major macroeconomic headwinds, including elevated bond yields, persistent inflation, strong energy prices, and central bank interest rate hikes, appear fully discounted into current market valuations. Capital inflows into physical gold funds and mining stock ETFs suggest the precious metals complex has likely established a durable bottom without retesting previous price lows. Unless global central banks implement unexpectedly aggressive rate hikes, gold and mining shares are predicted to hold their ground and gradually climb higher. Recent multi-week outperformance by junior mining equities confirms that market participants perceive current asset valuations as significantly discounted relative to physical bullion. Investors are increasingly recognizing value in beaten-down mining stocks as corporate balance sheets remain strong. As broader economic uncertainties persist, selling pressure across hard asset sectors is forecasted to diminish, paving the way for a steady price recovery across commodity benchmarks. Now, let's get back to the interview.
If you can just ignore the fundamentals, and the fiat currencies usually will fail over time, and everything that's going on to potentially cause the dollar to fail long term. If you step back and look at the long-term picture of the dollar, it has come down. It's put in a multi-year kind of basing formation. It's now starting to make higher highs, higher lows. We have the long-term 150-day moving average, which is this green line, which typically, if it is sloping up and all the moving averages are above it and prices above it, we're typically in a bull market. And so we have seen this happen for a long time. We've seen the dollar really put in a bottom in January of this year. We saw precious metals put in a peak, and now we're seeing the dollar enter a bull market. And I think that's going to put a lot of stress or hold, I think, precious metals down to some regard. Now, obviously, we've had a very sharp pullback recently with the Fed and the yen and all that causing a very sharp pullback. But I don't look too much into headline news driven moves. They can create an overreaction. We had a huge volume spike, so it was definitely a very emotional move and a lot of unwinding. And so now the dollar is trying to find support somewhere down in this 99 range. You can see it's had all these highs previously. It's broken through those, and now it's pulling back and it's kind of testing this critical support level. And I think it's just a matter of time, probably, before we start to see it. I think we could see the dollar continue to trade sideways for a while. I don't see the dollar rallying right away. I do think we're seeing the equities market start to shine. It's coming back to life. We've had a pretty broad market rally over the past couple of trading sessions here at the beginning of August. And I think the dollar is going to trade sideways until maybe the stock market starts to stall out. And then we'll probably see the dollar start to pick up speed and break out again while the equities market rolls over. So the dollar here is at support. I think it's going to hold its ground over the next month or two. It's going to probably keep a cap on precious metals. Metals may drift higher, which we'll touch on shortly, but I don't see the dollar breaking down just yet. It really has technically just entered a bull market, and it still has a very strong chart.
What we seem to be getting much more than, say, in the housing bubble, when the housing bubble burst, or when the dot-com bubble burst, what we seem to be getting much more is a rotation. And so you're seeing some of the big tech stocks, big tech growth stocks have come off. But you look at the value index, you look at the small cap index, look at the Russell 2000 versus the S&P, or the value index versus the growth index. The things that have lagged for the last few years are all outperforming. Foreign markets are outperforming. And so I think there is a possibility. One always has to be careful thinking that somehow the market can pop a bubble in one area and be very, very orderly in how it handles it. Have to be very careful with that. But I think there is at least a high possibility, but we will get, a rotation out of the extremely overvalued areas into the undervalued areas. That's certainly happening so far. And part of a reason for that is so much money in the market today, as we've discussed before, comes from, passive money into the S&P, but it comes from 401k plans. And so long as employment stays high, that money is just going to continue to move into the market. If you're employed and you have a 401k and your employer is matching it every year, depending on the company, but some companies it's just annual, some is every 6 months, you're asked where you want your money. Very, very, very few people say, why don't we just stick it in a money market fund? This is your sort of retirement money, your long-term growth money. And so most people put that into the S&P. And so that money just continues to pour around. So even if it's going into a managed ETF and the manager says, I'm not sure I want to buy NVIDIA or Microsoft today, they're still going to buy something, right? They're not going to keep it in cash. And so, I think the S&P could continue to do well. And that's why we're seeing this orderly rotation. When you have a market that's dominated by individuals making a decision, they are much more likely to say, I'm worried, I want to hold it in cash.
Financial markets are experiencing an orderly sector rotation rather than a chaotic speculative bubble burst. Capital is steadily reallocating away from high-flying technology growth equities toward historically undervalued segments, including small-cap indices like the Russell 2000, value equities, and international markets. This structural market shift is sustained by steady passive inflows from retirement 401 contributions and institutional asset allocations, which continuously channel capital into equity benchmarks as long as employment trends remain stable. Concurrently, technical chart formations show that the US dollar index has established a strong multi-year base and entered a long-term bull market structure. Following recent macroeconomic volatility, the dollar index is currently testing key technical support around the 99 level. The US dollar is predicted to trade sideways over the next month or two, while stock markets maintain their upward momentum. However, once the broader equity market rally eventually stalls out, the dollar is forecasted to regain upward speed and break out higher. This impending dollar breakout will ultimately exert renewed downside pressure on gold, silver, and precious metals over the longer investment horizon. Understanding these rotational mechanics provides investors with a valuable blueprint for portfolio positioning. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.